Having a portfolio of varied experts in your team is a sign of smart captaincy. Adopting a hybrid investing strategy works the same way. It diversifies your portfolio and offers you the safety of debt and/or gold and the potential of equity. Each asset class performs differently across different economic cycles. How do we deal with this unpredictability? The answer is hybrid strategy. It allows you to invest in 2 or more asset classes, and you can reap the advantage of less volatility compared to investing in pure equity funds. Whether you are conservative or aggressive in your investments, a hybrid strategy can work well for you. What are the factors that help hybrid strategy handle unpredictability? Risk-return profile, asset correlation, low standard deviation. Let us understand each of them one by one. Risk-return profile. Equity returns are relatively more volatile vis-à-vis debt and gold, leading to equity investment being riskier compared to the latter. However, equities have the potential to generate higher returns than debt and gold over the long term. Asset correlation. Asset correlation is a measure of how asset classes move in relation to one another over a period of time. When assets move in the same direction at the same time, they are considered to be positively correlated. When one asset tends to move up while another goes down, the two assets are considered to be negatively correlated. The extent of correlation can be measured by the correlation coefficient, which ranges from -1 to +1. Calendar year returns of equity, debt, and gold exhibit negative correlation between each other. Low or negative correlation between equity, debt, and gold creates a strong case for diversification, as combining negatively correlated assets can reduce risk. Adopting a hybrid strategy can result in low volatility. Let us understand how. Pure equity strategies are highly volatile as they concentrate on a single asset class, that is, equity. Hybrid strategies are less volatile than pure equity strategies as they have a mix of asset classes. Low standard deviation. Standard deviation is used as an indicator to measure market volatility, that is, measuring how widely the prices of an asset are dispersed from the average price. If prices of an asset vary in a narrow range, then standard deviation will have a low value, which means that the asset has low volatility. Conversely, if prices of an asset vary in a large range, then standard deviation will have a high value, which means that the asset has high volatility. Historical data suggests that following a hybrid strategy has significantly less standard deviation as compared to the Nifty 50 TRI. Manage the unpredictability of different asset classes and enjoy comparatively low volatility with a hybrid strategy. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.